Hey everyone, and welcome back to the channel. So, you've got some savings and you're thinking about investing. You hear about REITs, real estate investment trusts, and how they can pay you regular income, almost like being a landlord without the late-night calls about a leaky faucet. Sounds great, right? But which one do you even look at? Next week, 3 major Singapore REITs are about to announce their latest earnings, and it's like the season finale for investors. We're going to see who's been thriving, who's been surviving, and who might be in a bit of trouble. Today, we're going to break down what the big shot analysts are looking at for FCT, Keppel DC REIT, and Mapletree Pan-Asia Commercial Trust, or MPACT. We'll cut through the jargon and get to what it really means for you. And just a quick heads up, this video is created purely for educational purposes only. This is not financial advice, so please don't run off and buy anything just based on this video. Always do your own homework and conduct your own research or consult a licensed financial advisor before making investment decisions. Ready? Let's dive in. First up, we have Frasers Centrepoint Trust, or FCT. Think of FCT as the king of the heartland malls. These are the places you go to grab groceries, meet friends for lunch, or buy everyday necessities. The big story for FCT is its rock-solid performance right here in Singapore. Their properties are almost 100% full, which is incredible. Imagine owning a building and every single room is rented out. That's what they have. Even better, when leases came up for renewal, they managed to increase the rent by an average of 9%. That's a healthy pay raise. Their big move recently was buying the rest of Northpoint City's south wing, making them the full owner of one of Singapore's largest suburban malls. The analysts see this as a smart play to drive even more growth. But there's a catch. To make that big purchase, they took on more debt. Their gearing ratio, which is just a fancy term for how much debt they have compared to their assets, is a little on the high side, at 42.8%. It's not in the danger zone, but it's something to keep an eye on. It's like buying a bigger house. You get a better asset, but your mortgage is higher. So for FCT, the story is defensive stability. It's a pure Singapore play, so no worries about foreign currency risks, and its focus on essential shopping makes it resilient. The question for their earnings is, will the new Northpoint acquisition start paying off big time? Now, let's switch gears completely and talk about Keppel DC REIT. If FCT is the friendly neighborhood mall, Keppel DC REIT is the high-tech engine of the internet. They don't own shopping centers, they own data centers. These are the giant, secure buildings that house the servers for everything from cloud computing and AI to your Netflix binges. And right now, business is booming. The demand for data, especially with the AI revolution, is exploding. This has given Keppel DC REIT incredible pricing power. Get this, they managed to increase rents on renewed leases by a staggering 51%. That's almost unheard of. This has directly translated into more cash for investors. Their distribution per unit, or DPU, which is the payout you get, grew by nearly 13%. Unlike FCT, Keppel is spread across 10 countries, which gives them diversification, and they've managed this explosive growth while keeping their debt levels the lowest of the 3, at just 30%. This gives them a ton of financial firepower to keep buying more data centers, like their recent acquisitions in Tokyo. The story for Keppel DC REIT is all about explosive growth. They are riding the massive wave of AI and digitalization. The main thing to watch? Making sure they can keep finding and buying new data centers to fuel that growth. Finally, we have Mapletree Pan-Asia Commercial Trust, or MPACT. Their strategy is to be a mix of both worlds. They own prime assets in Singapore, like the super popular Vivo City Mall and Mapletree Business City, but over half of their portfolio is spread across China, Hong Kong, and Japan. And this is where their story gets complicated. Their Singapore properties are doing great. Vivo City is a powerhouse with strong rent increases, but their overseas assets are facing some serious headwinds. In China, the office market is weak, and they've had to slash rents by nearly 20% to keep tenants. In Hong Kong, while shopper traffic is up at their Festival Walk Mall, actual sales are down. And in Japan, they're dealing with a major tenant leaving, creating a big vacancy. Because of these international struggles, their overall income has dropped and payouts to investors have fallen by nearly 4%. Their overall portfolio occupancy has also slipped to under 90%, which is a major red flag for analysts. The story for MPACT is one of overseas challenges. It's a classic case of their strong Singapore assets being dragged down by weakness abroad. While it has the highest dividend yield on paper, analysts are worried that this payout isn't sustainable if the troubles continue. Their earnings will be watched closely for any signs of stabilization in those struggling markets. So, let's put it all together. What's the bottom line from the analyst report? The report crowns Keppel DC REIT as the clear winner and the most compelling buy. It has the strongest growth, the healthiest balance sheet, and is riding powerful tailwinds from the AI boom. It offers the highest potential for total returns. Frasers Centrepoint Trust is the runner-up, seen as a defensive and stable choice. It's perfect for investors who want steady, reliable income from the resilient Singaporean shopper without a lot of drama. The recent acquisition adds a nice potential for future growth. And the report suggests putting MPACT on the avoid list for now. That high 6.8% yield looks tempting, but the report calls it a potential value trap. The falling occupancy and negative trends in its overseas markets are creating too much risk, and that high payout might be in danger of being cut. So there you have it, a sneak peek into what the pros are thinking ahead of a huge week for Singapore REITs. We have a high-growth tech story, a stable neighborhood champion, and an international player facing a tough journey. It really shows that not all real estate investing is the same. The question is, what kind of story are you looking for? What do you think? Which of these REITs are you watching? Let me know in the comments below. And remember, one last time, this video is for educational purposes only. Please do your own research before making any investment decisions. Thanks for watching. Don't forget to like and subscribe for more content like this, and I'll see you next time.